Good morning, everyone. Thank you very much for joining. I'm just going to wait a couple of minutes until we get all the registrants in. So just bear with me while we wait just a little here. Okay, so it's 11:01. I'm thinking we might just give it another minute or two just to allow all those who registered to attend. Thank you, guys. Sorry for the wait. I just want to make sure we've got all registrants attending. So, again, just maybe one more minute. Okay, I think we'll get started now, and those that attend. So, firstly, a big welcome to all of you. My name is Justin Ishac. I'm one of the senior investment managers here at Sharewise. Obviously, just a few disclaimers before we get started. I'll be sharing my screen in a moment, but just obviously this is only informative. I'm about to go through all that. And at the end of the webinar, I'll be holding some questions and answers sessions as well. And those that want to book a portfolio review, we are also able to cater to those as well. So you'll get all that at the end of this session. So I'm just about to share my screen. Big welcome. Looking forward to do this webinar with you all. The Trump trade and the US picks for 25. Obviously, there's going to be a couple, and we'll get started. All right. So just if you do have any questions or you're having some technical difficulty, you can pop a question in the chat box as well. Okay, so I'll just get started now. So you should be able to see my screen at the moment. Hopefully you can all see my screen. Perfect, I think that's all good. Excellent. So Justin Ishac, Senior Investment Manager here at Sharewise. Disclaimers, as mentioned earlier. The information provided by Sharewise is of a general nature and does not take into account your personal financial situation, objectives or needs. The information presented today is for informational purposes only. And please make sure you understand the risks of trading stocks and securities. And I guess we'll get started officially. So the Trump trade. So obviously, well, introducing what we're going to really be talking about today, we're going to be talking about the Trump trade, a couple of stock picks, and then working with an advisor like myself and what that really looks like. We're going to also be discussing, and I'll be sharing my screen to give you a bit of an outlook on markets and trends and then the index itself in the US. And I'm very excited to sort of share a new phase here with Sharewise, where we're sort of delving a little bit deeper into the international markets. Okay, so we're here to sort of cater for a wide array of investors, and I think what most investors want to look for at the moment, especially with the Trump trade at this stage, is where are we going to put our money? Where are we going to hide our money? There are tariffs coming. There are these issues coming. Some geopolitical concerns. Is China going to retaliate? There's a lot of questions being asked. And we're going to go through all of that in this session. But obviously, if you want more of an in-depth sort of strategy session, I would say, very happy to work with you as well. We can organize all that. So Firstly, the Trump trade, what that really sort of indicates is it refers to market trends driven by policies associated with Trump's administration, obviously, and the potential resurgences of a wide range of various previous instances. So these policies, they do emphasize tax cuts, deregulation, infrastructure spending or investments, and it can favor certain sectors as well. So we will be touching on all of that as well. All right. Now, in the last sort of administration in the Trump administration, in the previous one back in 2017, the unemployment rate declined to historic lows. We saw, unemployment reaching 2.5% in 2019, which was the lowest in 50 years. Obviously, there were a lot of other issues that were happening around the end of 2019 and leading into 2020 with the pandemic and such. But job creation did surge in sectors like manufacturing, construction, and energy. And we'll be discussing a few issues related to that as well throughout the session. Sector performance, just some key metrics here that we noticed during that period in the previous Trump administration was key sectors that thrived were energy due to deregulation, the financials benefiting from relaxed regulations again. We've also had the industrials supported by infrastructure and manufacturing initiatives as well, right? So looking forward, we do think technology could still do well and may benefit due to tax cuts. So again, deregulation, hopefully, we do see a continued rate cut movement as well from the US Fed, which looks like may be the case as inflation recently came in line with expectations as well. Excellent. So I've just seen there have been a few questions that have come up already. So guys, I will touch on them at the end of the session, okay? So rest assured, I'll go through some of those. Now, so going back to the topic, so obviously the Trump trade, right? So tax cuts in general and corporate incentives, I mean, overall, we saw some economic implications. So GDP growth, unemployment trends, and sector performance were all a wide sort of topic of interest for a lot of investors. But what we want to look out for is, in particular, what sectors really outperformed, right? This is the main benefit that I think you will get out of this session, and that's obviously understanding what tax cuts and corporate incentives are really going to do to a lot of sectors, right? And deregulation. So the overview here, first of all, is tax cuts and the Jobs Act, so the TCJA of 2017, significantly reduced corporate tax rates from 35 to 21%, which is, again, it was leading to an increased corporate earnings and higher capital expenditure. So now it looks like it may be reduced even further. So this, again, will be, let's just say, another massive benefit for companies reinvested from their savings into expansion, share buybacks and dividend payouts. And again, the impact here is fueling market growth. So you're going to get the financials benefit here, industrials, and even technology from this. Deregulation, again, you've got the administration, again, rolled back numerous regulations in energy, financials and healthcare, which really reduced those compliance costs for businesses as well. So the key sectors that were affected were energy, financials, and healthcare. So, I mean, delving a bit deeper with the sectors. So energy, right? So why it benefits energy? So deregulation, what that does is it allows for an increased oil and gas production rate, which, while reduced environmental restrictions, lower operational costs, policies promoting energy independence, reduce reliance on foreign oil. And so this will drive domestic investment. So on top of that, you've also got investment in fossil fuel infrastructure and export growth, which contributed to sector gains, right? So the outlook here is with strong demand for traditional energy and emerging renewable initiatives, the sector remains very well positioned for growth. As a matter of fact, we've got a couple of stock tips. One of them is in the energy sector towards the end of the session I'll be sharing with you for you to have a look at as well. Obviously, as I said earlier, there is no advice to go and buy anything today. This is informative, and these are just stocks that look quite attractive that I'm sharing. Now, in that sector analysis overview, financials, why they benefit. First of all, deregulatory measures, right? So including the rollback of the Dodd-Frank enabled banks to increase profitability. And so rising interest rates, they're not really much of a concern here at the moment. Hopefully, we still see a continued easing or quantitative easing cycle, or I would say a stable interest rate decision for 25. And that should increase interest margins for financial institutions as well. So, the tax cuts are another additional benefit, which should boost capital availability for lending and mergers as well. So the outlook, again, is very favorable for the macroeconomic condition side to sort of push financials further for 25 in the US. Okay, so industrials and materials. So look, infrastructure, or I would say, yeah, so with industrials and infrastructure spending, I mean, at the moment, there's been a lot of proposals that have been seen to hopefully be of benefit to construction companies, heavy machinery and related services. And that's part of the whole Buy America clauses, right? So this is really incentivized, I would say, domestic procurement as well. So the additional factors there are obviously manufacturing incentives, which support growth in, let's just say, supply chains and job creation for the manufacturing sector. And again, this is also why, you want to be mindful of what policy implications are for certain sectors. But, at the end of the day, we do think industrials could really do well, but I don't think it's going to be the largest growth component for the portfolio. So those that are really looking for growth, I think you want to focus a little bit more on diversification in sectors that will benefit, but those that have a quality earnings projection, those that have a quality revenue stream. Meanwhile, sectors already mentioned, the quality sort of sectors and a bit more cyclical. There is a lot of growth potential in sectors outside of the cyclical names as well, which I will be sharing with you today. Okay, next one, which is my favorite, but it does pose the most risk, is technology, right? So why benefits? So why, let's say, the recent Trump administration should still benefit the technology sector is companies have benefited from government contracts and defense innovations from deregulation as well. So the deregulation sort of component and the tax cuts should fuel AI and cybersecurity. Okay. Now, on the other side of that, you've also got infrastructure for technology, data centers, energy needed to produce data centers and to have data centers running, which will fuel AI as well, and even quantum computing, right? So again, the additional factors here are reduced regulatory hurdles, encouraged innovation, particularly in emerging technologies like 5G and quantum computing, as I said earlier, robotics as well. You've got Trump really shaking hands with Elon Musk recently quite frequently. So you can only imagine the benefit that the administration may have on Tesla and Elon's other, I would say, incentives and other projects at the moment. So the outlook here is there is expanding applications in defense, healthcare, and infrastructure that will improve performance in those sectors from the technology that is improving and innovation that is improving as well. So that being said, I would say this is a sector where you can get the most growth out of, but you've got to play it right and you've got to be very careful. There is a very high risk, but the reward is just as high, if not higher. So you want to be mindful of that. And this is a sector that I think if you want to work with me, I have a lot of opportunities we can share together. Okay, so for 2025. And then the next is healthcare. So why benefits healthcare? Well, again, reduce regulatory burdens, allowing faster drug approvals and innovation, increased funding for healthcare technology, supporting biotech and medical device advancements, but also AI and technology will be fueling healthcare innovation as well. So there is going to be, we believe, large monetary spending in a lot of healthcare businesses. Okay, so what that means for you and your portfolio is if you're looking for income and yield, that's great, fantastic. However, you've got, I would say, one of the most game-changing years coming. You've got AI absolutely starting to peak at the moment. It's becoming the talk of the town, and it's been the talk of the town for a long time. And more innovation is growing from artificial intelligence, and healthcare is going to be a large beneficiary. So we have a lot of opportunities that will be coming in the healthcare sector as well. So if you've got stocks that are obviously high yield, but more defensive, that's great. But I really do think the best way you can defend yourself in this environment from the Aussie market is to consider looking at international equities. And the US market won't just defend you and preserve your capital. You're going to get some growth. Okay, there will be risk, there will be volatility. However, there will be such a reward if done right. And this is what I and us at Sharewise will bring to your portfolio on the US side as well. Okay, so healthcare, manufacturing, I think we all know what that means for manufacturing in general, so I'm not going to waste too much time on that. But manufacturing, why it benefits, tariffs on imports, protected domestic in industries, creating opportunities for reshoring manufacturing operations as well. Policies supporting the workforce development, and again, make America great again, is all about keeping everything in America, and manufacturing businesses should obviously reap the benefit of that as well, right? So next is defense. So high defense budgets, I can imagine, will probably be on the focus there, and modernized equipment and cybersecurity will be another area that will be a beneficiary of AI and technology again, right? So additional sort of factors, obviously export growth, opportunities in certain areas as well. But look, I think we'll just get right into a few of the key things. There are risks and considerations to consider with all of these sectors that I've mentioned. Volatility, markets may react unpredictably in 25 to geopolitical tensions as well, and some policy uncertainty. So you just want to be mindful of that. Obviously, policy implementation. Some proposals could face legal and congressional challenges as well. So that's another thing to keep in mind. And then you've got global impacts like tariffs, which could provoke retaliatory measures from other nations like China as a key example. And that could be an impact to Australian equity as well, or Australian shares in some cases, or some sectors in the mining space, for example. So you might want to be very mindful of that, guys. And again, this is why we say a balanced and well-diversified approach is crucial to managing these risks effectively. Okay, and that's what we specialize in here as well. Okay, so top stocks for 25. Now, this is probably the part that you're all sort of waiting to hear. So what I'm going to divulge here is not just the top stocks, but I'm going to also take a bit of a look at what we do to sort of pick these stocks as well, right? Just a bit of a complementary sort of understanding on how, as an investment manager or advisor, we would look at investing in some of the best performers for 25, right? So fundamental analysis, that's number one. Industry trends and risk management, obviously, right? So once you've sort of found the sectors that you want to look at with everything else that I've already mentioned throughout this webinar, you then want to sort of dive into the businesses and see what their earnings are, right? So what we want to see is we want to see earnings growth. We want to see a good valuation metric, and we want to make sure that the balance sheet, has strength, right? So from that perspective, we'll also keep an eye on net income, gross margins. We'll also have a look at, again, as I said earlier, earnings growth, but also interest cover is quite important, particularly with technology, okay? Price to earnings ratios, but the key, I would say, factor is earnings growth, earnings momentum, quarter on quarter, year on year, and sales growth, right? These are the areas, especially if you want some innovation, some growth in the portfolio, that you really want to focus on. And I've got a lot of businesses that will hopefully give some quality results, right? So these are things that we want to sort of tick from a fundamental perspective before we sort of nail down an entry point on technical analysis as well, right? And then industry trends, so companies positioned to benefit from macroeconomic shifts, and the policies that will be implemented as well from Trump and his administration. And again, risk management, so ensuring, we've got a balance of upside potential and downside risk mitigation. And the way we do that is implementing maybe stop losses. In the near, not so distant future, we will be also implementing options as well for clients. So that's going to also give you another strategy up your sleeve to protect you against downside risk. And that's another key way to really, again, get access to some hopeful quality capital growth, but protecting you if there's any significant downside risk as well from any of the macroeconomic, geopolitical, or fundamental changes that we see geopolitically as well. Okay, so just going to go into the first pick for 25, right? Which, you want to sort of keep an eye on for 25, and that's NVIDIA. Okay, I'm sure a lot of people have seen NVIDIA run before in 2024. Now, obviously, you might ask, well, have I missed the boat? Has it run? Look, I think it's fair to say when I pull up a chart, I'll take you through all that. But NVIDIA is a leading player in technology. Okay, so particularly in graphics processing, so GPUs and AI. Okay, why it's a pick? So, look, the stock has shown resilience and it does offer significant upside potential. Now, if the trends continue, it's going to continue to be a leading player in technology, particularly, again, in that AI sector or thematic. And the key reasons and the key metrics are, first of all, revenue growth. So in fiscal year 25, NVIDIA's revenue has shown large growth potential, okay, with a third quarter expected to reach an all-time high of about 32.5 billion, okay? So obviously from that point on as well, we've got earnings growth being projected to increase even more for the next quarter, for the next quarterly results. So you want to keep that in mind when they do report earnings. But we've also got potential target prices of about $180 a share, right? So from that perspective, we would argue, and when I take you through the chart, you'll see what I mean. It looks like a quality pick with a breakout for 25, okay, for a breakout trade. So, price to earnings ratio. So as of January, NVIDIA's forward price to earnings is roughly about 32 times. But overall, they're still sitting in a estimated price to earnings of about 50 as well. So, they are fluctuating between forward price to earnings and current. Okay. So again, price targets range from about 140 USD to about 280 USD, reflecting different views on the company's growth prospects. But NVIDIA's strong position in AI, data centers, and gaming continues to drive financial performance, making it again a noteworthy selection for 25. Okay. And you want to focus on this with an active management style. So you don't just want to hold it and sort of sit on it and just wait what it does forever, right? What you want to do is you also want to take into account that there is monthly inflation reports to be tracking, and that could cause a shift in monetary policy, which could be a negative for tech stocks as well. So you want to be very mindful of that, right? But the reality is it looks excellent at the moment. Okay, so we'd be looking at that as a pick. Now, the next one is ExxonMobil, XOM. All right, so XOM ticker, revenue growth is strong. So XOM is targeting about 10% compound annual earnings growth as a growth rate through all the way to 2030. Okay, offers a bit of a yield as well. Consensus target price is about $130 a share, which isn't bad, but it does range up to about $162, with the average actually being closer to about 140. So it does look like it could be an opportunity for the oil and gas space. It's well positioned to benefit from Trump-style policies as well. So deregulation in the energy sector, enabling increased production and reduced compliance costs. So when Trump hit the podium the other day, I think he said, "We're going to drill, baby, drill," right? So I think you can also take that with a grain of salt. But the point here is ExxonMobil is a favorable opportunity, we believe. So geopolitical conditions supporting domestic energy dependence as well, independence, and a robust capital investment style in renewable projects. which complements its fossil fuel dominance as well. Okay. The growth drivers are increased global demand for natural gas and oil, and strategic expansion into high margin projects and new energy technologies. Okay, so Exxon, we believe, is in a key sort of space for the year to really benefit from these policies. So we believe that this policy-driven tailwind will also increase the financial strength for 25. So it does come with, I would say, risk, obviously, as anything does. So keep that in mind. The oil price and concerns around increasing supply of oil and gas could also be an issue to the price of oil. So that could also weigh in on Exxon. So you want to be mindful of that as well. But at the end of the day, we do believe this could be one to keep an eye on as well for a potential buy. So that's Exxon and NVIDIA. Now, what I'm going to do really quickly is I'm going to also just sort of share my screen to the chart, okay, just to give you a little bit more value on, what we do for entry points here at Sharewise, okay, and the strategy I use as an advisor for clients and for prospective clients and myself as well, right? So this is, I just wanted to actually quickly show all those attending as well, the difference between the Australian market and the US market, which is just huge, right? If you have a look at the ASX 200, you can see this is the macro grid here, right? You can see we've got, obviously, it's trading at 8.3, right? Now, if we take a look at the percentage move since, let's go all the way back to about January, roughly, January 30. Well, let's go from here, right? January 30 of 24 to where we are today, okay? So you can see the percentage movement on the ASX has been probably just under 12%, right? Which honestly is minuscule compared to the NASDAQ and the US equity markets. So if we have a look at the NASDAQ composite, okay, and we go back to the same sort of time frame, I mean, it's just uncomparable. I'm going to be sort of kind here, but, it's really uncomparable. We go back from roughly, let's go from here all the way to where it is now, right? That's a 31% return on the NASDAQ year to year. I mean, if that doesn't tell you that we need to be investing in US equities, I don't know what will, right? So it's 3 times in movements in growth to the ASX. And this is because of artificial intelligence, technology growth, and a wide array of various reasons from a macroeconomic perspective as well. So, ladies and gentlemen, I don't think you can really compare, but the reality is the performance says it all. The NASDAQ is an index that's grown substantially, and we would really consider looking at some allocation to the US. Diversification is key, obviously. You don't want to put all your eggs in one basket. We could target high yield through the Aussie market, but look at some fantastic growth opportunities in the US, okay? So just consider that. I've got a lot of opportunities, by the way. So, if you really want to work with me and you really want to make some money this year, we can definitely, hopefully help you do that. Okay, so obviously everything comes with risk, but again, it's uncomparable if you look at the movement in the ASX compared to the US. Now, if we just take a look at the chart now, take you through, a few sort of stocks. So firstly, I'll just bring up NVIDIA, which I just mentioned as a potential pick for the year. Again, which you want to just keep an eye on entry points with. But if you have a look at it now, sorry, I've got a lot of stocks here, but right, you can see here. So this is a 200-day moving average. Okay, so this just helps me sort of indicate one trend. This is an RSI and a moving average indication as well, MACD. So look, I'm not going to go into the detail of my technical entry and exits, but I'm going to just give you an overview on why we'd look at some of these sort of stocks, right? So if you look at NVIDIA, the trend is just perfect, right? Every time it moves closer on the daily time frame, towards the 200-day, we get a nice breakout. Now, the reason for that is obviously from fundamental perspective of their earnings growth continuously outperforming, right? So their last result, they outperformed their earnings and revenue, and you can see the stock sort of consolidated in and around the Christmas period, obviously because of some concerns around the election, as well as, obviously a wide range of concerns related to the Trump administration and interest rate potential decision shifting views as well. So there were some macroeconomic and geopolitical and monetary policy concerns at the time. But you can see here at the moment, it's just turned bullish. We've got a nice breakout, a nice double bottom at the moment on the daily. So you can see here, double bottom, one bottom, boom, breaks up, comes down, new low, which is a little higher from the previous low on the daily, then a breakout. And you can see here at the moment, we're sort of trending on a bit of a channel, but it's more of a bullish channel, right? And if we can break out and push above 150, we could really easily see 180 come into the picture, right? If you have a look at consensus price targets as well, roughly that 20% potential at the moment still on the stock. So it does look interesting at the moment, okay? Just keep in mind they are reporting earnings on February 19th, so that's something to really keep an eye on, okay? So that's obviously NVIDIA. Now, I've got a lot of others that we can have a look at, but I'm just going to show you those that we've sort of picked in this webinar for the moment. And if you want more recommendations, you want to really work with me, you can have to obviously touch base with us to get, I would say, more of an in-depth sort of review and strategy session and recommendation, okay? So ExxonMobil, you can see just recently, it's just rejected the 200-day moving average. So we're just sort of being careful here. We would be monitoring this. Hopefully, I think we'll see some support around the 107 level. But if we break lower, I would want to see a retest and a support reached right here on the lower low, which is at only 105. And again, that's only about 3 or 4% anyway, right? So the potential way to play this, and again, this is obviously something to keep in mind with risk. Obviously, you want to really manage your risk here, is maybe a stop loss just below 104 with an entry and a take profit about 120 there, right? So that could be a nice 10% trade with a potential stop loss of 3.72. So the risk to reward is about 2.79, right? You're risking about 3% to make 10, which is much better than, sort of a lot of other trades that are out there. But obviously, the potential, given the fundamental nature of the company, could go a lot higher than 120 as well, right? So that's something to keep an eye on. You want to also watch out for their earnings. So their earnings are to be reported on the 31st of the month. So that's something we'd be very careful on, right? But the reality is we do think Exxon could be a nice trade here on a consolidated channel at the bottom end of the range, targeting about that 120 level potentially as well. If you look at the weekly does look like it's still holding up in this higher sort of bracket. Moving averages at the lower end of the range. RSI is moving to the upside on the weekly, and the trend is bullish in the longer term still as well, right? Again, you want to keep an eye on that. I do have a lot of other buy and sort of sell signals that I use with my clients, but again, this is just something that I wanted to quickly show you without going into too much depth. Obviously, if you really want to work with me, we can go into more depth, okay? So I'm just going to sort of go back to the presentation screen. Perfect. There we go. So obviously the value of professional advice, right? So actionable market insights, market trends, identify opportunities and avoid pitfalls. So it's not just about buying at the right time. It's also about monitoring your risk and making sure you've picked the right time to sell. That's probably more important as well, okay? So I've seen stocks that bounce significantly, and I've seen stocks that, sort of sell off significantly as well. So you want to be on the right side of either story, and we'll help you manage that, not to worry. So we've got comprehensive strategies around diversification, again, risk management, and long-term outlook as well, okay? You'll get timely updates buy and sell recommendations, daily global market and ASX reports, and trusted advice with over 10 years plus of financial market experience, and over 6 years, roughly five or so years of advice experience as well in the market. Okay, so we're reaching towards the end of the webinar. Now, what I'm going to do here, guys, I'm going to run a poll. Okay, so the poll will allow us to sort of get an indication on what your thoughts are with signing up with a membership with us. Okay, so you can also scan your QR code there and book a portfolio review. And alternatively, you've also got the option to click on the bottom right there of our resources to book a review as well, right? So I'm going to relaunch this poll. While we do that, I'll also answer a couple of questions that I've received. So one question that was from Doug, who registered for the session today, was how to select the best platform for retiree income and growth. Good question, Doug. Look, the reality is the best way to do that isn't through a platform. It's working with an advisor, okay? But at the end of the day, we have our own trusted resources that I think will be of more value to you. And also from a diversification perspective, again, we would recommend working with an advisor would be best, as opposed to just using a platform, okay? Because platforms aren't timely. They don't give you inter-market updates on something you should be potentially selling. We also have income opportunities, which are quite exciting here at Sharewise, that yield some fantastic income as well. We've also got a lot of other income opportunities to come next month, which are also international and domestic. So it's really exciting. So I hope that answers the question. I know it's not a direct answer to a platform, but that's because I do think you're best to work with an advisor as opposed to using a platform at the moment. Okay. Another question was, is Sharewise using AI to analyze and source stocks? Good question. Not really, right? But we do sort of implement some AI thematics within our technical analysis, which helps optimize our returns for clients. And at the end of the day, the reality is you want to sort of make sure that you're really looking at things from a holistic perspective and not just relying on AI as well, because there are other factors that do play into regular movements of the market that might not adjust to any AI platform at the moment as well, right? Another question was, does your service include cryptocurrency trading? Well, we do have some cryptocurrency recommendations that we do have, but they're not specifically crypto trades. They're actually recommendations as ETFs that you could add to the portfolio as well. Okay, so thank you very much for attending, guys. If you do want a portfolio review, I'm happy to sort of take you through one. Going to end the poll now. Okay. And thank you very much for joining the webinar today. Again, my name is Justin Ishac from Sharewise. That's my email as well. Work mobile and the website on the screen. If you do want to outperform the market, you do want to work with us. I think that's going to be the best way to go. I think I'll leave it there. Look, there's a couple of other quick questions here. Sorry. Here we go. So what platform do you suggest for US trades? Well, we use ComSec and AussieX. So if you work with us, we'll obviously be working with you on AussieX, which is probably one of the safest ways to invest domestically and internationally. Okay. So guys, I've really got to run now. I've got a lot of appointments to get to. It's almost 11:45. It's been about 40 minutes here. So thank you so much for your time. Any questions, you can also reach out to me. If you want to work with me, I'd be happy to work with you as well. So thank you very much for your time.